What if I told you that reading the chart correctly could be the difference between losing money every month and actually generating consistent returns from the markets? That is exactly what this video is about. I built this video in 2 parts, and here is why. Most people jump straight into trading without understanding the basics. They lose money, they get frustrated, and they quit. I don't want that for you. So in the first part of this video, I am going to give you the foundation that every serious trader needs. How to read a chart, how to identify a trend, and how to spot the key levels that the market respects again and again. Even if you have never opened a chart in your life, by the end of part 1, you will know exactly what to look for. And then in part 2, we go further. We take everything you just learned and we turn it into a real strategy. I am going to show you step by step how to use those key levels to trade options, how to position yourself at the right moment, choose the right strike price, and put the odds in your favor to generate money from the market. No fluff, no unnecessary complexity, just a clear, logical method that works. This is the video I wish I had when I started. So make sure you watch until the end, because the second part is where it all comes together. And trust me, you do not want to miss it. Let's get into it. So what I will teach you today will be really important and really decisive in your learning. I want to start by the basis of the basics. I will try to teach you the technical analysis that you will need in trading the markets and also trading options. It's important that you have in mind some notions of what is technical analysis. What are the support? What are the resistances of the markets? You need to know where the market is going to go, where will you have some volumes or not. And it's really important to combine prices and volumes to understand how the market trades, how the operators trade, the fundamentals of shares, of crypto, of ETFs. So it's really important to have in mind these notions and to know at least what are price action, what are volumes, what are the main support and resistance. What is the trend of the market? Is it bullish? Is it bearish? Is it neutral? Is it interesting to go in or no? Support and resistance are very important in understanding where the market moves. And that's really a huge signal for guys who are trading options and who want to make their strikes. I think the most important things that you have to have in mind for trading technical analysis are support, resistance, trend, and volumes. If you combine all these things, I think you will have good success rates in trading and in options. Now I will start by explaining the chart. If you are a beginner, stay with me. If you are already familiar with the markets, you can skip to the next part. Right now, I will speak to the beginners who don't know how to handle the charts. So the first thing we will have is the chart learning. The first thing to know is that every candle is a kind of representation of the price action. You can choose different representations in TradingView. You can have a line representation, but the most familiar one is the candle representation. Why is it important to have the candle representation and why is it important to understand it? Because every candle has 4 pieces of information. If you look at a candle, you will understand that the candle gives you the high, the close, the open, and the low. So 4 pieces of information that you get in one single candle. The close is where the market closed. The open is where the market opened. The low is the lowest part of the candle where the market went lower during that day. And the high is where the highest point was in the market during that day. So we have 4 pieces of information thanks to a candle. In a line chart, we have just one piece of information, which is the close price. That's why it's so important to use the candle representation to understand the market. It's quite an easy thing, not complicated at all. Now that we understand what a candle is, we will move to the next part, which is the time frame. Every candle represents a period of time. If you are on the daily time frame, every candle represents one day. It shows how the market moved during that entire day. If you change the time frame to 1 hour, then every candle represents 1 hour in the trading session. That gives you the information of where the candle started the hour, where it finished, what was the highest point, and what was the lowest point of the hour. You can also change the time frame to months. On a monthly chart, every candle represents one full year. And why is this so important? Because if you are a long-term investor, you don't care about how the market moves in 4 hours or 30 minutes. It's not an important point for you. So you will analyze the chart on 1 year, then 6 months, 3 months, 1 month. That gives you the biggest and most important picture of the trend of the market. It's important to start with a long-term interval to get a global and macro view of what the market is doing. But if you are short-term trading, it's important to have in mind both the macro view and also the micro view. So you will also look at 1 hour, 2 hours, 3 hours, 4 hours charts. So those are the two first notions, the candle and what it means, and the time frame and what it means for the market. Now the third point is to understand what the market is doing, which is the trend of the market. The trend is simply what the market is doing. Is it going up, is it going down, or is it neutral? There are three types of trends. The first one is the bullish trend, also called the uptrend. The definition of a bullish trend is when the market is making higher lows. The market goes down, then goes higher, then goes down again, but not as low as before, and then goes higher again. Every low is higher than the previous one. That is the definition of a bullish trend. For the bearish trend, it's the opposite. The market is going down and making lower points every time. The lows are lower and lower. It's quite an easy thing to understand. For the bearish part, the market is consistently going lower. We talk about a bearish trend, and then we have the situation where the market is doing nothing. This is what we call the neutral phase of the market, or also the consolidation phase. The market is consolidating. It's moving in a short interval, going neither significantly up nor significantly down. Those are the three most important types of market behavior to understand before you trade. Now I will talk about support and resistance points and what they mean for the market. This is the most important part. I think if you are trading options or spot markets, it's so important to have in mind the concept of support and resistance. The support is a price level where the market rebounds every time. It acts like a horizontal line. The market touches it, respects it, and then goes up. The resistance is the exact inverse. It's the highest point where every time the market rebounds, the market touches the resistance and then goes down. The market goes down every time it touches these resistance levels. Here is the most important thing to understand. Resistance can become support and support can become resistance. If the market breaks through a support level and then comes back to test it, that old support can now act as resistance. And the same in reverse. So the first thing you should always do when you are analyzing a chart is to trace the key points of support and resistance. That is the foundation of your entire analysis. Let me give you a concrete example with the gold price. In the gold price, we can see that the market is going higher, higher, higher. So we can talk about a bullish trend. And if we zoom in a little bit, we can see that the market is tracing a horizontal line, which is the support of the price. We can see that the first time the market touches this level, it rebounds. Then it touches it a second time and it rebounds. Then a third time and it rebounds again. So here we are talking about the support price of the market. The support level is the level where price touches it and then rebounds. And the resistance is at the higher level. Here we have a resistance because the price reached it but did not break through it. So the market is going to consolidate between these levels until a new trend driver appears. For the moment, it is consolidating. It's important to have this in mind because when you are trading options, you need to know the strike price. So to set your strike price, it's better to draw your support and resistance levels first, and then know where the market is likely to go. So let me explain this more deeply. If we have a market that is bouncing between support and resistance, and you are buying at support, you know that you have a big chance that the market is going to rebound. Why? Because this support has been respected 4 times already. What we can say when the market is touching the support for the 5th time is that we have a big probability that the support is going to be respected again. And then we have the rebound. Why do I say this? Because everyone in the market is seeing the same chart. Every operator, every buyer, every seller is seeing the same graph. So everyone is seeing that the market is at support and there are going to be buyers at this level. And at the resistance level, there are going to be sellers. That's why technical analysis is so important. It explains what the price action is and what are the intentions of the operators in the market. It works and it has always been working in the market because it's all about making the odds in your favor. So here we have the rebound that is expected. You buy at support and the probability is in your favor because you have great support there. And yes, you have to combine this with other indicators. Not just technical indicators, but also fundamental news. That is how you build a strong trading strategy. So once the market rebounds at that level, if you are trading options as a market operator, you will set your strike price at the resistance level so you can take your profits. You can bet that the market is not going below the support level. And if you are hedging another position, you know that the odds are in your favor at this level. You can go into the options and buy a call. You can make a strategy that respects this level with higher odds. It's all about odds. It's all about probability in the market. It's all about making the odds work in your favor. And that is exactly what support and resistance are about. Let me show you a real example. Let's look at how Tesla traded in 2025. We had a big drop and then the market started making higher lows. You only need 2 points to draw the level of support. And every time the market touched this level of support, it respected it and went back up. Every single time. This works because it's all about the psychology of the operators. Every buyer and every seller is seeing this chart and knows they have to buy at support and sell later. And the moment when the market broke this level, it fell sharply. So if you are a trader, you play the move. Every time it touches the support, you buy and go long, then you sell at resistance. It's also important to note the false breakouts of the market. Sometimes it looks like the market is breaking through resistance, but if there is no volume behind it, it's called a false breakout. The market goes back down because fundamentally it doesn't make sense and the operators are not interested in that move. If you are a trader, you buy every time at support. If a confirmed breakout happens, you close the position with a stop loss and move on. You may have had 8 or 9 successful trades. If one goes against you but you manage risk well, losing 9 pips while winning 90 pips on the others is a great result. It's all about strategy and execution. So I think what I explained in this video is really critical and really important for anyone who wants to trade options. You need to know how to draw your levels of support and resistance and understand what your asset is doing. It can be a Nike share, a Microsoft share, USD, Bitcoin, Ethereum, or anything else. You have to understand what the key levels of your chart are before you trade them. Just practice it on your TradingView account. It's free. If you understand just these key levels of any market, then you can start talking about how to trade them and how to execute a strategy in a market. Now we are taking it to the next level. We are going to talk about options, what they are, how they work, and most importantly, how to use support and resistance to choose your strike price. And trust me, once you understand this, you are going to see the markets in a completely different way. It is going to change everything in how you trade. But before we get into it, I want to tell you something. On this channel, the goal is not just to teach you theory. The goal is to give you concrete tools, real analysis, real market opportunities that I am going to share with you regularly. Setups that I personally see in the markets, specific moments where the market is on a strong support, on a key resistance, and where an opportunity is showing up. If you want to receive all of that, the only thing I ask you is to hit the subscribe button, like this video, and share it around you. It is completely free for you and it helps me enormously to keep creating this content. So if you haven't done it yet, do it now and let's get into it. So first question, what is an option? An option is a contract. A contract that gives you the right but not the obligation to buy or sell an asset at a specific price before a specific date. Let me say that again because it is really important. The right but not the obligation. That means when you buy an option, you are not forced to do anything. You have the choice. And that is exactly what makes options so powerful. There are two types of options, the call and the put. Let's start with the call. The call gives you the right to buy an asset at a specific price. So when do you buy a call? You buy a call when you think the market is going to go up. For example, imagine you are looking at a stock and you think it is going to move higher. Instead of buying the stock directly, you buy a call option. You pay a small price for this contract, which we call the premium. And if the stock goes up like you expected, your option gains value and you make a profit. If the stock does not go up, you lose only the premium you paid, nothing more. That is the power of options. Your risk is limited to what you paid for the contract. The put is the exact opposite. A put gives you the right to sell an asset at a specific price, so you buy a put when you think the market is going to go down. If the market drops like you expected, your put gains value and you make a profit. If the market does not drop, you lose only the premium. So to put it simply, you buy a call when you think the market goes up. You buy a put when you think the market goes down. That is it. There is one more thing you need to understand before we talk about the strike price, and that is the expiration date. Every option has an expiration date. That is the deadline. After that date, the contract no longer exists. So when you buy an option, you are not just saying the market is going up or down. You are saying the market is going up or down before this specific date. This is very important to keep in mind because even if you are right about the direction, if you are wrong about the timing, you can still lose money. So always think about both the direction and the timing together. Now let's talk about the most important part, the strike price. The strike price is the specific price at which your option contract is set. It is the price at which you have the right to buy or sell the asset. For example, if you buy a call on a stock with a strike price of 100, it means you have the right to buy that stock at 100, even if the market price goes to 150. That is where you make your profit. So choosing the right strike price is absolutely critical. And this is exactly where support and resistance come in. Remember what we learned in part 1. Support is the level where the market bounces back up. Resistance is the level where the market gets pushed back down. Now think about this. If the market is sitting right on a strong support level, what do we expect? We expect the market to bounce up. So what do we do as options traders? We buy a call. And where do we set our strike price? We set it at or just above the support level, because that is where we expect the market to start moving up from. Let me give you a concrete example. Imagine you are looking at a stock. Let's say it is trading at 100. And you can clearly see on the chart that there is a very strong support at 95. This support has been respected 3 or 4 times already. The market touched 95, bounced back up, touched it again, bounced back up again. And now the market is coming back down towards 95 one more time. What do? You buy a call option with a strike price around 95 or 100. Why? Because you know from the chart that the market has a very high probability of bouncing at this level. Everyone is seeing the same chart. Everyone knows this support is strong. So the buyers are going to come in at this level and push the price back up. And you are positioned to profit from exactly that move. Now let's look at the other side. Imagine the market is approaching a strong resistance level. The market has tried to break through this resistance 2 or 3 times and failed every single time. What do? You buy a put because you know the market has a high probability of getting rejected at that resistance and coming back down. You set your strike price at or just below the resistance level. And if the market gets rejected like expected, your put gains value and you take your profit. So here is the simple rule to remember. When the market is at support, you think call. When the market is at resistance, you think put. Support gives you the entry point for a call. Resistance gives you the entry point for a put. And the strike price follows the level you identified on the chart. Now I want to talk about something very important, risk management. When you buy an option, the maximum you can lose is the premium you paid for the contract. That is your risk. That is it. This is why options are so interesting. You know exactly how much you can lose before you even enter the trade. But here is the golden rule. Never put all your money into one single option. Never. The right approach is to risk only a small percentage of your account on each trade. For example, 2 to 5% maximum. That way, even if you have a losing trade, you are still in the game. And you can come back and take the next opportunity. So let's bring everything together now. Step 1. You open your chart on TradingView. You identify the key support and resistance levels. Step 2. You look at where the market is right now. Is it at support or at resistance? Step 3. If it is at support, you think call. If it is at resistance, you think put. Step 4. You set your strike price based on the level you identified on the chart. Step 5. You choose your expiration date. Give the market enough time to make the move you are expecting. Don't rush it. Step 6. You manage your risk. Never risk more than you are comfortable losing on a single trade. That is a framework. It is not complicated, but it requires discipline. The market will not always do what you expect. Sometimes the support breaks. Sometimes the resistance breaks. That is part of trading. But if you follow this approach consistently, if you combine technical analysis with solid risk management, you will put the odds in your favor every single time. And that is the whole game, putting the odds in your favor. And now I want to tell you something important. On this channel, we are going to go much further together. We are going to dig deep into this subject. We are going to cover advanced strategies, portfolio management, and most importantly, I am going to share real market opportunities with you on a regular basis. Concrete setups, specific moments where the market is on a key level and an opportunity is showing up right there. The kind of analysis that professional traders do every single day. But to get all of that, you need to be subscribed. So if this video brought you value, if you learned something today, I am asking you for just 3 small things. Subscribe to the channel, like this video, and share it with someone who wants to learn how to trade. It is completely free for you, and it is what allows me to keep creating this content and sharing these opportunities with you. The next video is coming very soon, and we are going to go even deeper. So make sure you are there. See you soon.